So one thing I often see small business owners getting confused about is all the different types of profit there are in a small business. And what I wanted to do today is just do a brief video, and I'm using my flip chart and my whiteboard today just to explain the different types of profit, because quite often, like, what people don't realize is not all profit is the same, and understanding the different types means you can start focusing on the right things and you can start drawing the right kind of conclusions to actually take your business to the next level, but also, more importantly, stop it failing, because failing at different levels of profit means different things. So I've actually written 5 levels of profit up on this board, but you might see 6 items. So I'm going to just start with the one that's not profit, and it's really the sales figure up here. So the reason I want to put sales in this guide about profits is because quite often so many business owners look at sales as profit, and I just want to, it kind of sounds dumb, or it kind of sounds like incomprehensible, but actually it happens so often. Business owners literally just look at, not all business owners, just some, look at what is coming in every month, and then they don't think about all the costs going out, they don't think about anything else that's happening, and they literally take that as gospel in terms of what they're earning. So I just thought I'd start with the one that isn't profit, so then I can actually talk about the ones that are and why they're all important. So number 2, or actually number 1, is the first type of profit you get to in a business is called the gross profit. And by the way, the way profit works in the business, and the reason why there's different types of profit, is because when you've got your sales figure, typically you take off expenses to get to a profit figure. That's the most basic terms way of looking at it. But however, the reason why there's different types of profit is because when you've got a sales figure, you can take off certain expenses to get to one type of profit, then you can take off additional expenses beyond that to get to the next type, and then you take off even more expenses, and then when you get to the very bottom, you've taken off all the expenses you can, and then you've got your ultimate profit down here. So I will talk you through them, but that's an overview of why there are different types of profit in a business, because it just depends on what expenses that you actually take out before you look at the number. So going back to this, so like after sales, which is not profit, but I put it there so I could explain that, we actually have the first type of profit, and that is gross profit. So a lot of people will view this as the sales figure they've made, and then what they've done from that is they've taken off anything that directly relates to that making that sale. Let's say you're shipping a load of products to a customer, then one of the costs that directly relates to that sale is having to buy the materials or buy the actual product in, and then you might have to have cardboard packaging to box it up in, and you might pay courier costs. So it's really important to understand gross profit. Quite often I find business owners not putting the right things into the gross profit category, so then they get like a distorted view of how much money they're actually making. But gross profit is so important to a business, because one thing it really tells you is if you're charging enough money, or if you're making a loss per every item you sell. If you're making a loss at the gross profit level, that means essentially that you are selling something for less money than you are paying for it. And it's really important to understand that, because it might seem like the dumbest thing in the world, but actually business owners sometimes get trapped in that, either because they don't actually have awareness of that gross profit number, or quite possibly there's costs that directly relate to a sale which they categorize in other overheads. So it's really important to understand that. Like, the first thing is just categorize your costs correctly. The way to look at it is, if you didn't sell that item, would you still have that cost? So a good example is if you had to buy the item to sell it, then you probably wouldn't have that cost if you didn't sell it. But I know a lot of the time it's sitting in stock. But the other side is, like, if you didn't sell that item, would you still have to pay for your accountant? Would you still have to pay the rent on your building? The answer is yes. Then that rent on the building or accountant, it probably doesn't sit in gross profit. It sits further down in your other overheads. So moving on from gross profit, I'll go to the next one. And that is what we call the contribution. The contribution is also really important, because what it starts doing is recognizing that not all overheads are what we call fixed, and some are what we call semi-variable. There are certain costs in your business that you might not be able to directly link to one sale, but in general, if your level of sales reduced, your level of that cost would reduce, and that is what we call a semi-variable overhead. And the reason why It's a very similar reasoning to the gross profit. When you actually factor in things like specific staff costs, let's say you need someone to package that box that can go out to a customer. Let's say you've got to buy a particular bit of software that relates to 5 customers you've got, but not all of your customers. When you start assigning those costs to your gross profit and then work out your contribution after that, then the contribution then is another indicator of if you are actually charging your customers enough money. It's very, very important to understand. Always understand if you're charging your customers enough money, because if you don't charge your customers enough money, your business will fail. The next level is what we call the operating profit. So the operating profit is where you factored in all your other overheads, like things like rent, accounting fees, maybe certain subscriptions that you need for your whole business, and then you end up with that operating profit figure. Quite often this is quite easy to see in your zero account because it says operating profit, and it is literally just like this is everything you paid out for versus everything that came in. And it's important to look at that, and I'll explain why in a second when we get to net profit. So the next level is net profit. This is where you put in all your accounting adjustments and things that aren't necessarily an actual cost to your business. They're more of a notional cost. A really good example of this is like director salaries. Like ultimately, if you put director salaries when you're working out operating profit, you might actually find that your profit looks much, much lower than it is, because in reality your director salary is probably not what you're worth as a director, because you get paid a lot of it as dividends, but also it's not an actual cost to your business. It's more of a notional cost to your business, which you put in there to save you money on your tax bill. So this is where, when you're working out net profit, you put in all your adjustments like depreciation, everything else. If your depreciation is actually quite accurate in terms of what your equipment's worth, maybe you would stick it in operating profit. But really, net profit is for anything that it hasn't been like a physical cost to your business or a cost at the market value. And that's really important, because that net profit is what your tax bill is worked out on. But the operating profit is just the best indicator of if your business is profitable overall. And I also call operating profit the annual salary equivalent, because if you were ever there trying to decide whether you're making more money being self-employed or the director of your business than you would in employment, well, if you looked at the operating profit, really looked at all the costs that your business has had, apart from those notional ones like depreciation and director salaries, maybe use of home, things like that, then that would be the best indicator of if you're actually making enough money and being able to then compare it to going out and getting a job. So the net profit is important because that's what you work your tax out on. So you then end up with a profit after tax. So based on your net profit, you pay a certain amount of corporation tax, or don't if you made a loss, and then you end up with your profit after tax. And the profit after tax is where your dividends come out of. So obviously you need a profit after tax to pay yourself dividends. If you haven't got that, then you can't pay yourself dividends. And don't forget, that's got to be cumulative as well. So if you made a massive loss in the last 2 years and then just started to make a profit now, you may not cumulatively be in a profit. So it's worth factoring that in. So in the interest of not making this video too long, what I just wanted to do is invite you to replay this as many times as you need, because all of these profit levels in a small business are really important. They tell you different things, they highlight different problems, they highlight different strengths, and if you've got that awareness, then you'll be able to grow, but more importantly, you'll be able to avoid failing. They're both important. Anyway, I'll see you at the next video. Thanks for watching.